Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Mark Perry, managing director at Wilshire, with $1 trillion of assets under administration, to discuss private markets in 2021. Mark, it's great to have you with us. Welcome to Trade Talks.
Great to be here. Thank you.
First, how about some definitions? When you say private markets, what are you referring to explicitly? What are we talking about here?
Yeah, so private markets is an umbrella term. What I mean by that is, everything illiquid, essentially, in closed-end private structures. So first is private equity, the largest part of this market, and that includes all of the private equity sub-strategies: leveraged buyout, venture capital, growth equity, and special situations. Private markets also includes private real asset strategies. The most prevalent amongst these are private real estate, infrastructure, natural resources, and the like, as well as private credit, direct lending, distressed debt, mezzanine amongst the most prevalent. And it also now, it kind of includes everything in between. There's some strategies that are really interesting that don't fall so neatly into one of the above categories. Alternative yield is a great example of this.
Going into 2021, what are the macroeconomic factors you believe investors should focus on to help guide private markets portfolio decisions? What are the key dynamics currently impacting the market, and what are the outcomes?
So as a general statement, the private markets are less influenced than the public markets by short-term macroeconomic issues. Now, there's obviously no escaping the impact of COVID and the long-term secular shifts that it has either catalyzed or in some ways accelerated. The funds we invest in are typically 10-year funds in terms, so these short-term phenomena matter, of course. There's context to that, but it's really the structural shifts that we focus on and try to capitalize on. At the macro level, there are several forces at work, which we show on this slide here. Most notably, obviously, the vaccine catalyzed recovery, the post-COVID new normal that we're all emerging into and investors need to consider, and the secular shifts that we're seeing in certain sectors: healthcare, e-commerce, and technology, that are permeating nearly all parts of the private markets today.
Let's get a little more specific. In North America, can you tell us which areas of the market provide attractive opportunities in 2021, and which sectors would you avoid?
So in this graphic, we address some of our specific views in around the North American private markets, and we use these views to help guide our approach to investing. As we show in the dials to the right here in private equity, we see buyouts and special situations as being amongst the most favorable strategies. Historically, recessionary vintage years have been amongst the strongest performing within these strategies, given their ability to capitalize on market dislocations. Within this cohort, we have and continue to be particularly keen on sector-focused managers in strong segments such as healthcare and technology, to name a few. When it comes to private real assets and private credit, we view infrastructure and alternative yield as attractive sectors. Both of these are likely beneficiaries relative to similar sectors from some of the macro trends we're seeing that we just discussed, as well as the inefficiency of the markets that these strategies focus on, which is really important. A few trends that support this view. First, in buyouts, we see the cyclical effects and government actions we believe should continue to create opportunities for those managers best equipped to capitalize on complexity and exploit opportunity from complexity. Sector-focused buyout managers targeting markets with strong secular tailwinds, again, such as software, are poised to outperform in the post-COVID new normal, we believe. In special situations, market dislocations generally provide a tailwind to special situation strategies. And so for these managers with these strategies, certainly their time has come. For infrastructure, we continue to emphasize renewable and digital infrastructure, which suggests the possibility of buoyant deal flow in the near term. The prospect of increased U.S. government infrastructure support finally is well established at this point. with the confluence of COVID stimulus objectives and others, and presumably supportive Biden administration, we think this thesis should now be much more actionable. And then finally, an alternative yield as interest rates compress, and direct lending, very much the core of the private credit market, continues to show signs of risk without commensurate returns. We believe that lower correlation, non-traditional yielding strategies have a place in diversified portfolios. So as far as sectors to avoid, we are on the side of caution today in the natural resources area of the market, specifically in the oil and gas sector, where we see headwinds from potential heightened regulation and the potential for dampened economic demand.
And Mark, how about in Europe? What are the main factors impacting the region, and what does that mean for the private markets?
Well, similarly to North America, to some of our North American themes, we spend a lot of time focusing on the forces at work in Europe, as this is an important focus area for us in our program. Due to the pandemic, unemployment rates have risen in Europe as they have elsewhere in the world, which hampers consumer confidence as well as spending. As a result, we continue to favor more defensive industry sectors underpinned by demand, really regardless of the state of the economy. Certain industries with recurring revenues are one example of areas where we found opportunity last year and continue to focus this year. Demographic shifts in Europe are a strong force further creating investable opportunities in areas such as education, healthcare, responsible investing, value-based products, as well as financial services. And technology, to my point on recurring revenues, remains one of the few secular growth areas and opportunities in Europe. Work from home and e-commerce have obviously accelerated these trends, and kind of secondary and tertiary effects of these, cybersecurity, big data, and the like, are also very interesting investable opportunities today. A few trends that we think support these views. First, in venture capital, a really interesting area of the European market. Valuations in Europe are generally lower than in the US for equivalent technology, equivalent management teams, and global customer access. So there's a kind of a valuation arbitrage almost with certain parts of the European venture capital ecosystem. Second, in special situations, with many companies, hitting peak leverage at a time when profitability is under pressure. The credit rating agency Moody's, for example, foresees the number of defaults peaking in the first part of this year. Consequently, special situations managers, groups that are able to capitalize on this complexity with turnaround stress and distressed investments are well positioned. In infrastructure, government spending is expected to be further directed towards supporting jobs, also investing in healthcare, ESG, including decarbonization, digital infrastructure, are interesting areas where we see good opportunity, and in some cases a premium over more core infrastructure strategies. And finally, alternative yields, similarly to North America. While the market in the US for alternative yield is significantly deeper, in Europe, strategies like asset-backed loan portfolios, catastrophe bonds, funds specializing in non-life insurance claims, capital relief trades with banks are examples that have come to market that we find interesting. Each of these share those same characteristics as we discussed previously: lower competition, uncorrelated risk, and of course that yield, which is so important today.
And Mark, in our last minute here, do you still think that private markets are a good place to invest for 2021?
We do. There's a lot to be excited about here. Obviously, risk abound. The headlines of all-time highs across asset classes, liquid and illiquid, continue to be top of mind for us. And this valuation risk is now joined by uncertainty around this post-COVID world that we're emerging into. Private markets obviously aren't immune to these trends. However, with careful attention to the right strategies, the right sectors, a deep knowledge, and prudent manager selection, we continue to find interesting opportunities in 2021 and beyond.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.